It is April 10th, really early Wednesday morning or late Tuesday night. And we're not sitting at an all-time record high for the first time in a while. This is the video log that takes 30,000 to a million. We're going to get there. And after I give you a rundown of what has happened in the account today, we're going to talk a little bit about the trade, the options trade that I was discussing on the last log, and inspired by my man Mikwan, I'm going to run you down through that trade and what I was talking about, how you can scale up your call option sell. So, all right, let's go into the browser here and we'll see what happens. Whoa, that was not what was supposed to happen. All right, there we go. We're going to go and get to that later. So let's see what we got here. We got EXK, $12 gain today, negative 90 on Apple. Dropped as anticipated. I got a little bit scared though for a second. It was sitting at a good 202 point, almost 5. Oh, past it even. 202.66, but then it made a downturn. So now we're sitting a little bit below 200. So I dodged that trade, and once I get into the details, you'll find out what I'm talking about. Currently, I have a call sold on Apple at $202.50. Other contributors to the losses today was EDF, which is the emerging markets fund. All these other dividend-paying instruments. C-SPAN was down. FAX, which is the Asia fund. Weight in precious metals, another negative $42, which is a silver and gold mining streaming company. Uranium was about flat, and that's about it for all the action. Most of these options lost value, which is great because that's what I want to happen to options that I sell. I want them to lose value so I can buy them back at a lower price or have them expire worthless. The week so far, 1 week in review, I've gained a little bit over percent, 1.09. Comparing that to SPY, you can see SPY is down 0.08 in a week's period. And let's see, compared to Apple, 1 week in Apple equals 3% gain. So had I been in Apple the whole time, I would have done much better, but still beating the market, which is my main goal. All right, so now let's unfold this trade, right? So what I was talking about yesterday, so I have 100, actually 101, but I have let's say 100 stocks of Apple. I have those, right? So what I did was I sold a call. Let's show you right here. All right, so if I click on Apple, you can go on trade options. You can do this on the phone, of course, as always. You click on sell, you choose your date, which is April 12th in my case. And then right here, you see this is a call option that you can sell, and you can put up your 100 shares as a collateral. So what's going to happen is by the 12th, if the price of the stock of Apple, if it reaches over $202.50, I will be automatically forced to sell my stocks, all 100 of them, at this price. So no matter what the price is, it can be $300, I will be forced to sell at a 202.5, right? So that's what I'm getting paid to do. I'm getting paid to take that upside, to eliminate that upside risk. And so I sold it for about $40 or something like that, 40, $50. And so now what's happened is on Monday and Tuesday is that the price of Apple has been creeping up this number. So what I mentioned is that it's better probably to buy back this option at a loss at $100, take that $50 loss, and then sell a different option at 205 to give Apple a little bit more room to run, so I can get $250 more out of its appreciation, right? And basically negate my earlier trade that I did. And so I wrote it all down for y'all so you can see it. And this is what it looks like, right? Let me see what it looks like on the thing. Okay, perfect. So you can see here we got, oops, It's not supposed to happen. So first I sold a call. Well, this is an easier example. It's actually one step down than what I actually did. So let's say I sell a call at 200, and so if the price goes up to 200, I don't get any more additional gains. So that's it. Even if it's $300, no gains. All right. So, but if my call option was at a 202.5, I would have 250 extra dollars that the price can run forward before I was forced to sell. So if the price, let's say, reached 203, then it wouldn't be that big of a, I would be only missing out on $50 of gains by Friday, for example. So that's the whole idea. And what I do for that is I would buy back my call for $100 because it's appreciated a little bit because the price of Apple would have come up. And so I would take a $50 loss, okay? Because I'm buying something for 50 and then I'm selling something for 50 and then buying it back for $100, right? So that's a $50 loss. And so then to mitigate that loss, I would sell a call at 202.5 and then get my account credited $50 and I would be even, right? So I would be gaining 250 in potential gains, and then I would be eliminating my gain or loss, assuming that I wait till expiration. All right. Now, if the price drops below 200, then I take the $50 loss and then the $50 credit, and I just end up with the 100 stocks that I had originally. So let's say the price of Apple was $199, and I would just keep those stocks, and it's like I did nothing, right? I did not make a trade, options trade at all this entire week. That's what would happen. That's what the equivalent would be. However, if the price dropped, so it's kind of a bearish thing to do to sell a call. So you're basically betting that your stock is not going to go up past a certain level. So I was hoping that, and I'm still in this trade, I'll show you in a second, that the price will not go over, right? Let's go back to the actual options trades here. So I'm betting that the price will actually not go over 202.50 by Friday, because I'm anticipating kind of a leveling off in price here because it's had a crazy run. So, and I would be rewarded, $50 or so for taking on that risk. So that was the whole idea. Now, if it doesn't work out, I'll be forced to sell my shares, at 202.5. Take the profits that I've gained from Apple so far and then look for a lower level to buy from. Or I can turn around and I can sell a put with the money that I receive, which would be 20,250, something like that. So, and I would be selling a put against whatever the price is at that time. Hopefully it drops back down to, let's say, 200. So I would be able to sell a put. The price won't be 102 per option contract. It will be, different. It will be higher if the price is low, and it will be lower if the price is high. So hopefully I sell a put and then collect premium. That's the whole idea of selling options, is to collect premium, really. If you buy options, obviously you're kind of gambling. You're looking for price appreciation or depreciation, and a drastic one, unless you have it covered with another option and enter into an option strategy, which we're not going to cover today. But my idea is, the way I make money, right, is to collect premium through waiting and betting that the price will not reach my targets and just collecting the cash. But the whole idea here is that you want to play this game, right? You want to make sure that you're playing this game with stocks that you like, because if your price targets gets hit once you sell a put, then you get to collect that stock at a price that you're comfortable with spending money for, right? Even if it's above the market price at that very moment. And the only reason, you would need to own the stock in the first place to sell a call against it. So selling a call, you want to also do with stocks that you like. You're just betting that the price of the stock that you own is overheating, right? The business that you're owning is overheating a little too much, and you think it's going to correct. So you're basically getting paid money premium for taking on that risk, and willing to sell your stock if you think it's overvalued at the price that you agreed on. So it's a very good way to maneuver through the markets on your own terms, right? And not just having to sell or buy on the whims of the market at the price that the market decides, and only dealing with spot price. So here's the process again. All right. Hopefully, screenshot it, pause, whatever, go through it, imagine it, play it down through your website or phone, and do the math and see how it would work out. All right, and see if you can manage to make it work for you. And I can English. Okay, so that was a little bit exhausting, a little mental energy there, but if you're confused, maybe replay it. I suggest just going into the website and just looking through the charts that I just looked at and try to really understand them, right? Click over here, trade options, and then play around with the buttons and really try to understand and look at the price differentials, right? So you can see over here every um, options contract is 100 shares. So what you would do is you have to multiply this by 100 every time you make your calculations. So I've sold, um, a call against Apple at $202.50 for 75 cents each for each option, which makes it $75 for the whole operation, for the whole contract of 100 shares. It's called a contract, right? There's some other helpful stuff right here. It gives you this is really helpful, the break-even price. So what this tells me is that if I sold this contract right now for $75 premium, then including that $75, my break-even price is 203.25 cents, which means that if the price reaches that level, then I would be breaking even on the whole trade, right, including the premium. So it basically adds the premium into the price sell point. If the price is 204, then I would have been better off selling at market price, right? But let's say the market price is 202.75, then I'm still in the money, right? I'm still winning on this trade. Like, even though it's not, I'm using some of the credit, some of the premium here to purchase the stocks. I'm getting some premium for free. All right, so I've been getting paid a little bit of money, although not the full amount, for waiting and for taking on that risk. All right, and then I will just flip it over to the other side. So instead of selling a call, this is what the sell call chart looks like, right? Then selling a put, right? And this is the price points, and you can just maneuver up and down to take a look at how the price changes. Obviously, when you go really far down, they flatten out into like 1 penny. Nobody trades those, and those are not market prices, right? This is like no market price. No one's gonna buy and sell this for like $4,000. If we look over here, you'll see that the volume is zero, right? Open interest is zero, so no one's really trading that because it's too far off and it's too unrealistic that those price targets will ever get hit. So you wanna always work around something that's close to the prices, something that's realistic and has a high probability of getting hit. So let's say, for example, that you're betting that the price is going to stay over 200. It's going to be over 200 by Friday, so you sell a 200 put, and you're going to be credited $200 for waiting. And then if the price is under 200, you're going to be forced to buy the shares at 200, and it gives you the break-even price right here. So as long as it stays under over 197.96, then you're making some kind of money. All right, which is pretty close to the current spot price. Okay, hopefully that helps. If y'all have any questions about how all these options work, especially on Robinhood, it makes it a little bit easier. Even if it looks more complicated than other brokerages, online brokerages, because it's just numbers and entering fields, and you have to resort to third-party sites in order to get everything cleared out and all the graphs visualized and everything like that. I don't really want to mention any of the websites or brokerages here, but if you look hard enough, you can find them. I'm just gonna focus on Robinhood just because I like it and I want to keep everything simple and friendly, easy to understand, and quite frankly, it's enjoyable. I mean, the reason why I'm operating with in Robinhood is just because I enjoy the simplicity of it and I really like how the platform works. So anyway, that's about it. No all-time high today. We even apparently dropped below 56,000 right now. I am anticipating some kind of weakness in the market here. We've had such a crazy run, so that's why I'm selling some call options and have that SH running. So SH is the short market ETF here, S&P short market ETF. So that's why I have that running as well. And hopefully I can pick up some more shares and sell some call options, sell some put options when the market drops a little bit. And I'm willing to take the loss because the market could also go up. So, I'm probably only about, 10-15% bearish, 90% bullish on my account right now. If the bull continues pretty crazily, I'll turn more bearish. But bearish just means that your negative outlook on the market, and also has implies that you've positioned yourself in such a stance to be negative on the market, and bullish just means you're positive on the market, in case you guys are not familiar with those terms. All right, so that's about it. Well, I don't know. Hope you got some useful information there. And I'll probably make another video tomorrow or the day after. All right, peace.